Have you ever had what felt like a perfect trade setup just completely blow up in your face? Well, the problem might not be your signal, it might be your perspective. Today, we're going to dive into something called top-down analysis, a method that's designed to fix exactly that.
So let me ask you this. Have you ever been in this exact situation? You spot what looks like a flawless setup. You're feeling confident. You put your trade on and then, bam, the market does the exact opposite of what you expected. It's got to be one of the most frustrating things in trading, right?
Yeah, you see that strong green candle bouncing right off support, you go long. And the second you get in, the market just tanks and smashes your stop loss. And you're just left there scratching your head thinking, but I did everything right. So what on earth went wrong?
Well, the answer almost always lies in seeing the bigger picture. So here's our game plan for this explainer. We'll start by diagnosing that failed trade. Then we'll introduce top-down analysis as the solution. We'll break it down with a super simple framework, walk through a step-by-step example, see why it's so powerful, and wrap it all up by covering the common mistakes so you can avoid them.
Okay, so let's get right to the heart of the problem. It's an incredibly common mistake, especially for newer traders, and it's what I like to call the single frame trap. And the problem is, really, it's pretty simple. You were staring at one tiny piece of the puzzle. You saw this great-looking bullish signal on a short-term chart, but you totally missed the massive bearish river it was flowing against on a larger time frame. You were trying to paddle upstream without even knowing it.
And that is exactly where top-down analysis comes in. The best way to think about it is like having Google Maps for the markets. It's a system that makes sure you're always aware of the traffic, the main roads, and, your final destination before you ever start driving.
So what does that actually mean? Well, it's a method where you start big, you start on a large time frame to figure out the market's main direction, and then you drill down to smaller and smaller time frames to find your perfect entry point. You're always going from the general to the specific, from the top down.
Let's just stick with that Google Maps analogy because it works so well. Step 1, you zoom way out to see the main highway. Is the market generally headed north or south? Step 2, you zoom in a bit to find the right street where an opportunity might be. And finally, step 3, you zoom in even further to pinpoint the exact address for your trade entry. Now, to do this right, you really need to use at least 3 different lenses, or you can just call them timeframes. And each one has a very specific job to do in your analysis. So let's say you're an intraday trader. Your large lens, that's going to be your 15-minute or maybe your 1-hour chart, is only for finding the overall market direction. Is it bullish? Is it bearish? Or is it just going sideways? Then your medium lens, say the 5-minute chart, that's where you hunt for a high probability setup that actually lines up with that bigger direction. And then finally, you've got your small lens, the 1-minute or 3-minute chart, and that is purely for execution, pinpointing that perfect moment to get in. All right, theory's great, but let's make this really practical. We're going to walk through a real example using Bank Nifty just to see how this all comes together. So we start with our large lens, the 15-minute chart. And remember, our only goal here, the only thing we're trying to do, is figure out the market's bias for the day. Are we looking to buy or are we looking to sell? That's it. On this chart, we're going to ask 4 simple questions. First, what's the trend? Are we making a series of higher lows? That suggests a bullish market. Second, where were the key levels from yesterday? Go ahead and mark the high and the low. Third, where are the major support and resistance zones? And finally, are there any of those big psychological round numbers nearby, like 52,000? Those things are like magnets for price. So, looking at all this together, the higher lows, the nearness to support, we can establish a pretty clear bullish bias for the day. Okay, so now that we've decided we're only looking for long trades today, we switch over to our medium lens, the 5-minute chart. And here, we're not just looking for any random setup. We are specifically hunting for a bullish setup. So the most important thing here is alignment. We patiently wait for a clear confirmation signal on this chart. Something like a shift in momentum, what some people call a change of character, where a little downtrend breaks and starts heading up. This shift often creates a perfect little entry zone, a price pocket where we can plan our entry. And now for the final step. We've got our bullish bias confirmed from the 15-minute, we've identified our entry zone on the 5-minute, so now we switch to our small lens, the 1-minute chart, for that razor-sharp execution. This is where we actually pull the trigger. We wait for the price to pull back into that zone we found on the 5-minute chart. Then, on the 1-minute chart, we watch for a specific trigger, a bullish candle, like a hammer, for instance. Once we see that, that's our signal. We enter. Our stop loss goes just below that zone, nice and tight. And here is the magic of this whole thing. Our profit target isn't based on this tiny 1-minute chart. No way. It's based on the major swing highs from the 5-minute or even the 15-minute chart, which gives us a much, much larger potential profit. So yeah, that was a decent amount of work, right? Moving across 3 different charts. And that brings up a pretty fair question. Was all of that zooming in and zooming out really necessary? I mean, couldn't I just trade off the 1-minute chart and call it a day? Well, let's take a look at the difference.
And honestly, the difference is night and day. On the left, if you're only trading the 1-minute chart, you're basically reacting to every little flicker, every bit of noise. You're trading blind. But on the right, when you use top-down analysis, it's like you're walking a clear path with a map in your hand. You have high confidence, you're moving with a dominant trend, and you can see your destination crystal clear. Now, even with a great map, you can still take a wrong turn. So let's cover the 3 most common mistakes that traders make when they're trying to use this method so you can steer clear of them.
All right, mistake number 1 is the time frame mismatch. This is the cardinal sin of this method, seeing a big bearish 15-minute trend, but then taking a long trade on the 1-minute chart just because you saw one little green candle. No, all your timeframes have to agree. Mistake number 2 is skipping confirmation. This is just pure impatience. You get your 15-minute bias and you jump straight to the 1-minute entry, completely blowing past that crucial 5-minute setup. And third, ignoring the large frame. Never, ever assume that a strong resistance level on the 15-minute chart won't matter on the 1-minute. Trust me, it absolutely will.
Look, this might feel like a lot to juggle at first, but just like any other skill, this takes practice. If you really work through this process on every single trade, over time, it's going to become second nature, just an intuitive habit. And when it does, I promise you, you will see a huge improvement in your trading accuracy.
So, if there's one single thing you take away from all this, let it be this. Stop trading a chart. Start trading the market. Stop getting lost in the random noise of a single time frame. Use top-down analysis to gain perspective. Trade with the trend and start operating with real clarity and confidence.